Welcome to Edupedia World. I am C. Radhika Singhal. Today we are going to continue the last lecture for working capital. In the last session we were discussing regarding account receivable management. Today we are going to continue the same topic. We are going to do one more illustration. Just because this topic is very important and as per the past trend, generally 16 marks question is either covered from account receivable management or from estimation of working capital requirement. So this illustration was from a past year examination. The details are: a company intends to produce a new product, prices are rupees 1000 per unit, and an expected annual sales of 5000 units. Variable cost amount to rupees 750 per unit. So there is a 250 rupees contribution. And a 2 months credit period is granted. It is estimated that 10% of customer will default. Others will pay on the due day. So the estimation of bad debt is 10% of total sales. So out of 5000 units, 500 units are expected to default. Interest rates are 15% per annum. So basis this information, you can calculate the opportunity cost of bad debts or the blockage of the funds. A credit agency has offered the company a system which it claims can help identify possible bad debts. It will cost rupees 2,50,000 per annum to run and will identify 20% of customers as being potential bad debt. So though the company is identifying or is estimating that 10% will be bad debts, but how much the credit agency is claiming? 20% of the customers. If these customers are rejected, no actual bad debt will result. Should the credit agency be used? So the credit agency will only be used when the savings will be more than the cost that we have to pay to the credit agency. So what are the incremental gains if the credit agency being opted? First, there will be a saving in bad debt. 5000 units are being sold and it is estimated that 10% will be bad debt. So, and the selling price per unit is 1000. So for 500 units into 1000, 5 lakh rupees the sale value which can be company could incur as a bad debt loss. But if the credit agency will identify those debtors, there will be no bad debt. So there is a gain of 5 lakh saving on bad debt loss. The next is the opportunity cost on account of reduction in investment in debtors. The company has interest of 15%. The credit agency will identify 20% of the debtors as bad debt or potential bad debtors. For those 20%, if the company is not investing or will not sold those goods to those 20% debtors, the company will sell because there will be no investment, no blockage of funds on those debtors. How much investment is there? That will not be on the sales value because the cost that the company has incurred will be the variable cost only. So 5000 units sold into 20%, that means 1000 for 1000 units, multiply by 750, for which the company has actually invested in the funds. The debtors have a average collection period of 2 months, that is the credit period, into 2 by 12, multiply by 15%. So there is a saving in opportunity cost of 18,750. So total incremental gain is of 5,18,750. The incremental cost includes the agency fees of 2,50,000 and also because the company will identify 10% additional debtors. So company will not going to sell that goods to the 20% debtors which are identified by the credit agency as the potential bad debt losers. So 1000 units for loan, 500 units into 20%. There's a 250 rupees contribution per unit. So for 1000 units, it will be 2,50,000. There's a loss of contribution on that. 5 lakh rupees is the incremental cost. And there's an incremental gain of 5,18,750. So there's a net incremental gain of using the credit agency of 18,750. So the credit agency could be used by the company. Next is estimation of working capital requirement. Now, this is also very important because if the company estimates its working capital requirement, basis which the company will maintain its profitability, its liquidity into the company. This could be estimated on a total basis or on cash cost basis. Total basis is generally used when the company has to prepare a projected balance sheet for a project. So the basic difference between total basis and cash cost basis is the non-cash expenses are being excluded. So if you think about non-cash expenses, that is depreciation. So in cash cost basis, the estimation is excluding the depreciation expense because there is no cash expense over depreciation. It's only an expense which is incurred for tear and wear of machine with the fixed assets, but there is no actual cash outflow. Cash cost basis working capital requirement is estimated when the company purpose is to actually evaluate that how much flow of funds is there, cash flow is there. Let's do an example that how to estimate the working capital requirement. Let's say that this is the estimated projected cost statement of a company. The raw material consumed is 6 lakh, wages of 12 lakh. So there's a prime cost of 18 lakh rupees. Then factory expenses of 6 lakh rupees. So the factory cost of goods sold will be 18 plus 6, 24 lakh. Let's say the company operates at a profit of 50%. So how much is the sales amount? 36 lakhs. Now debtors are allowed 2 months to clear off their dues. Now think what I have to compute. I have to compute it. How much working capital should be there in my hand? Right? If I have sales of 36 lakhs, out of this, if I assume that all the sales are on credit basis, so 2 months debtors will be there in my books as at year end, right? This means that the company will keep 2 months debtor funds available in the company on account of debtor sales. Next information is creditors on purchase allow half month of credit. Now, the company desire to keep inventory equal to 2 months consumption and finished goods remain in warehouse for 1.5 months. And there is also a lag in payment of wages and factory expenses in 1 month each. So the company outflow of funds will be in inventory, in debtors, in raw material purchase, but the funds that could be reduced by the lag in payment of creditors and lag in payment of wages. So if we estimate the working capital requirement, the investment in raw material will be, if you go back, how much raw materials consumed in the whole year? 6 lakh rupees. So for those 6 lakh, 2 months is to be kept into the business as per the operating cycle of that. So turnover period is 2 months. That means 1 lakh should be maintained for purchasing of raw material. Similarly for inventory of finished goods, 1.5 months is a lagging period. The total cost of goods that we have just in the projected given statement that the factory cost of goods sold is 24 lakh rupees. So for the 24 lakhs, 1.5 months in amount is to be invested into the business. So 24 lakh into 1.5 divided by 12. This implies 3 lakh rupees plus debtors, which is our total sales. 2 months is the average collection period. This will be 6 lakh. Less, you do not have to pay the wages immediately. There's a lag period of 2 months. So 1,20,000 is the total wages into 2 by 12. 1 lakh is to be reduced. Factory expense of 6 lakh. And there's a 1 month credit period. Arrears which has to be paid. So 50,000. Factory expenses not to be paid. And similarly, the creditors has to be paid after 1.5 months. So less 75,000. So how much is the working capital required? It is 1 lakh plus 3 lakh plus 6 lakhs. Less 1 lakh, less 50,000, less 75,000. 7 lakh 75,000 is the working capital requirement of a company. So basically what we estimated that how much funds do we need basis the turnover of that period. So raw materials to be key for 2 months. So that much funds should be available with the company. Finished goods for 1.5 months. So whatever amount that you have invested in the finished goods, 1.5 months investment is to be kept into the business, less the amount which is to be paid in the arrears. Right? So if I just write that in a formula basis, how do we estimate current assets? The investment in raw material is equals to raw material consumed into its holding period divided by, like if that's a 2 months holding period, that's by 12. If it is given in days, then it should be divided by 360. If it is in weeks, then it is divided by 52. So all these formula, that's very logical. But still, if I write it as a formula, if it's a work in progress, then work in progress will include raw material, labor, and other overhead expenses. So raw material is computed on the total holding period. Now what about the conversion cost? Conversion cost includes the cost of labor and the overheads. In case the degree of completion of work in progress is not mentioned, then for raw material we assume that 100% has been consumed and the conversion cost will be 50%. So the labor cost, whatever has been incurred, we multiply that by 50% to get the actual conversion cost of work in progress. Finished goods is computed on the total cost incurred to produce a good. So that will be factory cost of goods sold. So into how much for how long that finished goods will stay into the business till it is converted into sales. Into FG holding period, debtors will be how much credit sales you have multiplied by average collection period and divided by the period, like total period, and prepaid expenses. And likewise, if you have to estimate the current liabilities, for purchases it will be net credit purchase multiplied by average payment period divided by the total period. And outstanding expenses is expenses for the year into how much lag payment is there. In this way you can estimate the total requirement of outstanding expenses. So this example that we just did is on a total cost basis. There is no thing about depreciation and all. We computed the debtors on the total sales value. Now let's do one example on cash cost basis. This example was also there in your previous year examination. Decor Limited sells goods at a uniform rate of gross profit of 20% on sales, including depreciation. So whatever sales amount is there, that 20%, like whatever the manufacturing cost is there, that manufacturing expense include depreciation. Its annual figures for the current year are sales at a 2 months credit of 24 lakh rupees, material consumed, supplier credit 2 months, 6 lakh rupees, wages paid monthly at the beginning of the subsequent month. So it is paid at the beginning of the subsequent month. That means there's a 1 month lag. 6 lakh rupees. Manufacturing expense, cash expenses are paid in 1 month arrear of 6 lakh rupees. Administration expense of 1 lakh 50,000. Sales promotion expense paid quarterly in advance 75,000. The company keeps 1 month stock of raw material and finished goods. So you got the time lag for raw material and finished goods also. A minimum cash balance of rupees 80,000 is always kept. So whatever will your estimated working capital requirement basis the above information, we will also add 80,000 as a minimum cash balance. The company wants to adopt 10% margin safety in the maintenance of working capital. So whatever working capital that you estimated, there is a plus 10% margin. A company has no WIP. Find out the requirement of working capital of a company on cash cost basis. You have to require ascertain working capital for Decor Limited. Now, what is the sales value? 24 lakh rupees. And there is a uniform rate of gross profit of 20%. This means that what is the total manufacturing expense? 24 lakh less 20% of 24. That means 80% of 24 lakh rupees. So manufacturing cost is 19,20,000. But since we have to compute basis cash cost basis, the information given is that it includes depreciation as a part of cost of production. So we have to identify that how much is the depreciation portion. It's already given that manufacturing expense includes material, wages, outstanding depreciation. Material wages figures we separately have. So 6 lakh is the material cost and 4,80,000 is the wages. This means that manufacturing expense is of 8,40,000. Out of this 8,40,000, there's a cash manufacturing expense of 6 lakh. You can go back to the question. Manufacturing expense 6 lakh rupees. This implies that the depreciation is 2,40,000. 8,40,000 less 6 lakh rupees. Now manufacturing expense is of 19,20,000. 24 less 20%. Depreciation of 2,40,000. So excluding depreciation, the manufacturing expenses of 16,80,000. You have to add back the administration and sales promotion expense to compute the total cash cost. So cash cost includes all the cash outflows of the business. So when we add back administration expense and sales promotion expense, the total cash cost will be 19,05,000. Now we estimate the total current assets requirement and less the total current liabilities requirement. Raw material 6 lakhs is consumed and the holding period is of 1 month. So for raw material, we need 50,000 pounds. For finished goods, it's on factory cost of goods sold. So when you go back to the question, manufacturing less depreciation. We will not include depreciation while computing the finished goods cost because we have to compute on cash cost basis. If this question is on total cost basis, we would have taken 19,20,000 to compute the finished goods holding period. So finished goods of 1,40,000. Debtors. To compute for debtors, we will take the total cash expenses. No profit is to be taken into consideration. No depreciation will be taken into consideration. So cash cost is 19,05,000. Holding periods of 2 months. So the debtors working capital requirement will be 3,17,500. There's a prepaid sales promotional expense for 3 months because it is paid quarterly in advance. So 75,000 into 3 by 12, 18,750. The current liabilities. Creditors is all the total purchases, which is of 6 lakh rupees, and there is a 2-month holding period. So 1 lakh rupees is the total creditors. Manufacturing expenses paid after a month, 1 month at lakh. So 6 lakh into 1 by 12, which is 50,000. Administration expenses are paid after 1 month. So that will be 12,500. And the wages are also due for 1 month, which is 40,000 rupees. So if you go back, the working capital requirement will be 6,06,250 less the total of the current liabilities, which come up to 4,03,750. It also says that it requires a 10% safety margin, so that will be 40,375. So the total working capital requirement will be 4,44,125 rupees. This is how to compute it on cash cost basis. If it has been asked to compute the same on total cost basis, the finished goods will be on 19,20,000. Debtors will be on the total sales value. This will be the difference. So if I just put in formula wise that what is the difference between total basis and cash cost basis. If I have to compute inventory of WIP, on total basis it will be RM consumed plus conversion cost. There will be no difference. And the conversion cost will include depreciation. In cash cost, that conversion cost has to be reduced by the depreciation charged. Similarly, for finished goods, the factory costs will include depreciation, while in cash cost basis, the factory cost of goods sold will not include depreciation. That will exclude depreciation. Debtors is computed on the net credit sales, while in cash cost basis, we have to compute the cash cost of credit sales. And to compute that, We have to reduce the profit percentage from the net credit sales and the depreciation portion. Right? Thank you so much. Keep smiling. And that's the end of this chapter. In the next class, we're going to start another topic. Have a great day.